So you've got a fragile-looking China where anti-corruption, environmental issues, and reforms are topping the agenda at the largest political gathering of the year. Let's find out what the investment implications are with Frederic Neumann of HSBC. Very nice to see you. Some of the commentary coming out from the NPC were quite interesting. So you've got this largest budget deficit since the global financial crisis, China on a reduced setting. What is your biggest takeaway in light of the fact that some people are wondering whether this is actually a hard landing in disguise?
Well, it's very interesting that they're now starting to use fiscal policy to support growth, because the numbers have not been looking very encouraging lately, right? The economy continues to slow, they're cutting interest rates, but they now also are starting to use fiscal policy to try to support particularly the construction sector, because that is suffering from a slowing real estate market. And so they're doing everything to put a floor under economic growth.
How much easing needs to be priced in? Is it all done and dusted?
China still has challenges, right? The real estate sector continues to slow, and that's really the heart of the Chinese economy. And that continues to weigh on employment, steel industry, glass, cement, etc., investment overall. And so the Chinese have to continuously add more easing to the picture, not just on the fiscal side, but probably also more on interest rates, for example. And that will likely lead to further capital outflows, because as China reduces interest rates, money will start to flow out. It's already happened in the last 6 months. It's nothing to worry about. It's not that China's facing a funding crunch, but it does mean that the currency, for example, could weaken a little bit more.
How much more? Do you have a call?
Well, we don't think it's going to be that dramatic. We think that no more than 5%, probably 3-4% by year end. That's the maximum. And there are expectations in financial markets, for example, by some investors who are saying that China is suffering because it is tied to the US dollar. And as the US dollar appreciates, that hurts China. And so maybe they're going for a more dramatic depreciation. But the reason not to expect that is that really changing the currency is not going to fix the domestic problem. The problem is the real estate market, not exports. And therefore, why depreciate the currency?
Are they taking the right remedies to fix the issues in the real estate market?
Well, they have to accept that needs to be a slowdown in construction. So construction, real estate construction as a share of GDP is probably a fifth of the economy, which is much higher than it was, say, in the United States. At the height of the subprime bubble in the US, construction was 7% of GDP. In China is well over 20%. So it shows you how large the sector is. It has to deflate. It will take several years, and during this period, we're likely to see slower economic growth.
Slower economic growth. There's also specter of deflation. The authorities seem to be acknowledging this. Inflation targets even set at 3%. What happens to corporate profits? They're already being squeezed.
That's right. And deflation is obviously always dangerous for an economy that has a lot of debt. And China has accumulated quite a bit of debt in recent years. So the authorities will try everything to at least maintain positive inflation. And one way to do that is through faster credit growth, cutting interest rates, and encouraging investment, but not in the sectors where we have overcapacity. So they're trying to fine-tune investment into other areas, and that is outside of real estate, outside of steel and cement, going into new sectors like alternative energy, energy production in general, into the car sector, in electronics, and all sort of upscale sectors. That's what they're trying to grow, and hopefully that will cure the deflationary pressures.
Yes, we certainly hope so. China is easing, and ditto for India as well. Give us a perspective between China versus India in light of the fact that both are easing, but against very different economic backdrops.
It's interesting, actually, that India just revised its economic numbers and now seems to be growing a touch faster than China. So they're neck and neck, according to the official economic data. And India is perhaps in the better part of the cycle because they already had the slowdown. Now the central bank can cut interest rates and help to spur the economy again. In China, we're still unwinding some of the excesses that we saw from the previous few years. So it's more likely that India will start to see a pickup in growth, whereas China might still continue to slow.
What sort of easing do you expect?
We think one more rate cut in the next few months, and then they might actually stop cutting interest rates. But the reason for this is not that inflation is a problem, but it's that the central bank has a new mandate, and that is targeting inflation. And the recent budget has instilled that as a law. And so central bankers tend to be very cautious when they're told to target inflation. They don't want to miss the target right at the beginning, so they're likely to be a bit more cautious.
Yeah, it seems like the Chinese are taking a page out of what the Europeans are doing. Thank you very much for that. Really appreciate your time, and do visit us next time when you're in Singapore. All right, Frederic Neumann there of HSBC.